This is Saturday, the 31st of March 2012. So that's this update comes right at the beginning of the financial year, and markets are poised at a very interesting point. The very short term has been very erratic. Typically, my expectation was that the vertical rally that we saw from Jan-Feb, once it ended, would see a vertical sell-off. Probably if it had run up much higher to probably the 58,000-59,000 mark, you would have seen it come that way, but stopped at the 61% retracement of the entire fall of last year and has been forming a distribution pattern since. So while we would have liked to see it fall one-sided, we've seen it coming back and bouncing again and again, and which is why the short-term trend has changed a couple of times, probably causing confusion for some of you thinking that I'm changing my view. That's not the case. I don't think I can see any evidence of a change in stance as far as the bigger picture is concerned. In fact, the risks have only increased. My sense, as I explained in my last update after the budget, I was looking for more confirmation, which would have definitely come below the 5140 level. But basically, I think what has happened this week, this month, we've got the weekly, monthly, and quarterly closings now for the end of March. And what has happened is that the budget essentially gives me a sense that the bigger view that I was looking for, the risks from inflation and interest rates, and also the monetary cycle and the currency, all of them are slowly confirming my thoughts along the way. The idea that which I put out on in various quantitative articles, that you actually see a reversal of the economic business cycle. I think I put it out way ahead of time, and by the end of 2010, it was almost at a point where I thought I had to think whether I was right or wrong. I think starting with last year's budget, the 2011 budget, the first time it was announced that we would actually look at reducing the fiscal deficit, and I think that was an indication of things to come, that you actually wanted the economy to at least the financial side of the economy to actually slow down or contract. Even though purely numbers don't tell it, yes, the fiscal deficit per se may have been higher, but you've seen that cause a slowdown in GDP growth. You've seen that basically what happens is that money gets allocated differently than it was before. And after hearing this year's budget, I think everyone everyone who was looking for positive upsides should have been shocked. And I think that shock was simply visible across speakers in this community, because most of them went from extremely positive to defensive stances, rather than even coming out and saying that something was completely wrong. So I think that itself is a telling story, that it's clear that the cycle is turned down and there's not much you can really do about that. You have to consolidate finances when you are at a high debt level, and that has a direct impact on your economy. So I think that part is clear. The RBI stance that they will cut rates as and when they have enough evidence is clear. Though, as I mentioned, that the bond yield charts have been showing that bond yields would shoot up. I showed that in the interest rate chart in my Jan presentation, which I uploaded recently. And now it's only now, because in Jan people started hoping for rate cuts, and when it was announced, when the possibility was announced, they did not even say they would do it immediately. And I think we've actually seen the yields actually start moving up against those expectations only in the last month, and I think that has made the charts turn out to be more right than people's general expectations. A similar issue is happening with the currency. I think for very long have been expectation that the rupee would depreciate. The fundamental factors behind that were not so apparent, but now I think just in the last 1 week you've had two very good articles in the financial media. One highlighting that for the first time India has only 4 months worth of reserves to meet its import obligations, and that's a very rare scenario happening after a very long time. the media says first time since Lehman, but I would actually say the right thing to say would be first time since 1991 that we are seeing the reserves contract slowly and fast, rather not slowly, but yes, definitely towards that point. And what it means is that, and you're already seeing some of it, is the first time it happened is what triggered reforms, the first round of reforms, and that involved convertibility on the current account. For long, people have pushed for capital account convertibility, but it's been moving slowly. I think this could become the trigger. You've already seen in the last quarter allowing foreign money into government debt, allowing foreign money into private debt, then allowing foreign money into and allowing opening up ECBs in various sectors. These are all steps towards capital account convertibility. It's very apparent that we are having a currency crisis slowly building up. You wouldn't call it a crisis yet, but all the indications are there that it's going to be one. So while these steps might be in the right direction in terms of providing us, some kind of support to the economy, that you do not have such a crisis because you're opening up the capital account. It comes at a very unfortunate point, that is that when you expect your entire finances to be financed by the external flows at a time. I mean, while it would have been really good if that happened over the past decade, but at a time when the world is facing deflationary forces so strong that you already have contraction in China, you have contraction in Europe. Most of Europe is slowing down because of the path that they have chosen, that is to deleverage through austerity. And deleveraging essentially means a contraction in capital, and that's leading to the setup for one of the best rallies in the dollar against many currencies around the world. And therefore, attracting capital in this environment is going to be extremely difficult. Even if we do go for increasing degrees of convertibility, we're going to find it more and more difficult to attract capital, because capital will be deleveraging from around the world, moving back to the US, and that is going to keep pressure on the Indian currency. So I think that so we have two clear trends: one on the currency side, one on the short-term interest rate side. I'm sure interest rates will peak somewhere, but I think the bond yields indicated at least up to 10% on that chart, and so we still have 150 basis points upside risk left there. And what has been happening on the global front in the last month has been very interesting. While the US markets might have continued to sustain higher levels, not yet confirming the sell signals, you have meaningful intermarket divergences within the US, where some of the indices like the transports utilities have given sell signals on their weekly charts, negative closes on the monthly. But even more interesting, that pattern is there across the board for 70 to 80% of the European markets. They've closed down for the month. Their weekly momentum has gone into sell. It has happened for Shanghai, China. The entire rally that occurred since late December ending up being corrective, confirmed corrective, selling off from the upper Bollinger Band down with the weekly momentum going into sell too. So you have the Chinese market starting a third wave down. You have many European markets reaching a break point. Specifically, I would mention Spain. I sent out the chart of Spain a couple of months back, and I've shown, in fact, I've sent several times showing the multi-year head and shoulders pattern. As and when the Greece problem has shown up, Spain's chart has seen its stock market fall back to the neckline of the head and shoulders, bounce back from the neckline, head there again even in October of last year, bounce back again in the recent rally, each bounce being smaller than the previous one, and now it's already fallen back to the neckline, another 2-3% drop, and it would have broken the neckline, becoming the second country probably to break its long-term multi-year support and going into a multi-year low, something which Greece did a year back when it broke its similar neckline. And Spain is at that point, and I'm sure various other European markets which have been lagging, like France, would also then get there. And that's probably going to be a major negative force going to come in over the next couple of months. think it's right in front of us. Like I said, all the indicators have already turned down, so it's already started happening. The only country where we still need to see that pressure build up is probably the United States, and the recent jump in 10-year Treasury bond yields is an indication that it won't be very far behind, but it's probably going to be lagging the other markets. So you have a lead in Asia selling off, you have Europe following through. India has made its high in late Feb and not been able to surpass that. In fact, we've been making lower tops and bottoms, even though we have a bounce right now, which is either done with or does another 100 Nifty points on the upside before we are through. But it would again make another lower top, and the next leg down then would only get more severe, is what my sense is, based on what I'm able to see across charts. The third area which is also showing signs of losing steam is the commodity segment. The recent oil rally did push up a lot of agro commodities, but we saw them cool off this week. But again, yesterday they've pulled up a little. You're seeing copper unable to get past the 61% retracement of the entire fall of last year. It's made some kind of triangular pattern there, which is still to confirm on the downside, but at least indicators have turned down, and we're looking for some confirmation to come in. And the CRV index is indicating that there would be some downside to the commodity space. Crude, which was looking extremely bullish to me for quite some time, fell back and broke below that $104 mark, which means the rally is probably aborted. But you still have a weekly support which it's held many times closer to the $102 mark. Once that clearly breaks, then it would be then we could clearly say that oil has aborted its rally, and the next leg down has started. Till then, there could still be an unexpected last spike on the upside, because Brent somewhere has not completed its fifth phase, and that's probably the only hidden potential that commodities do make one more attempt. But the CRV chart itself does not show that. Momentum indicators even on crude has sold off on the weekly, and you have a negative close on monthly chart. So I think two things are clearly there across many markets. Closing down for the month, momentum indicators on the weekly confirming to the sell side. There are just some key levels which are holding on, breaking of which would further confirm the bigger patterns turning that have already turned down, or actually starting the real selling pressure actually starting. And that's what is really missing, but the topping process seems to be complete. And so I think we are looking at an extremely weak or negative quarter, or quarters I would say, for the rest of the year ahead. Unlike the expectation at the beginning of the year that we would probably have a bad start and a better end to this year, I think we've had a good start, and you're probably going to have a very bad end to this financial year. But hopefully that would be, at least from the Indian stock market point of view, the worst would then actually get done, is what I'm hoping for. But the cycle, the business cycle and the economic cycle remains downward, which is very clear in everything that I've looked at. It's just the markets that are holding up and should soon confirm the trends that have now clearly started building across the board. So I hope this update gives you an insight into what I'm looking at. The short-term daily updates will continue to try and capture that move and highlight the risks as and when they show up. But I think the big picture will remain that we are building up for a serious and significant sell-off from pressures that are developing from world markets, currency markets, and commodity markets. So that's all from me in this extended update.